Welcome to the Deep Dive. We are Talk Tickers, and today we're digging into Kawasaki Heavy Industries, or KHI. Specifically, their Q1 results for the fiscal year 2025.
Yeah, and this was a really interesting one. You had these truly record-breaking revenue numbers coming through. Really impressive stuff.
Absolutely eye-popping on the top line. But on the other hand, when you looked further down, there were some pretty significant pressures squeezing that bottom line.
Exactly. So it's not just a simple great quarter story. It demands a closer look at what's actually driving these numbers, what the moving parts are, and what it might signal for KHI going forward.
Right. It's one of those calls where the headline number doesn't tell the whole story. So let's unpack it. Starting with that top line. KHI reported record revenue, $488.44 billion.
A huge number. That's a big jump year over year. And like you said, it beat what a lot of analysts were expecting.
And business profit, which is KHI's kind of core operational measure, that also looked pretty healthy. It rose to $20.51 billion. So first glance, things look good.
But yeah, as you hinted, the picture gets, let's say, more nuanced as you go down the income statement. While that business profit was up, profit before tax actually declined to $16.82 billion.
Okay, so it dipped there.
And then the really critical one for shareholders, net profit attributable to the owners of the parent company, that saw a really substantial decrease. It shrank down to just $4.24 billion.
Wow, that's quite a drop. And I understand that missed estimates pretty significantly.
It did, yeah. It missed street estimates by a fair bit, which, signals maybe some earnings quality questions for this particular quarter.
Right. And translating that to per share figures, the GAAP EPS, earnings per share, that was 25.39, also down from the previous year.
So definitely a weaker bottom line performance year on year.
But then on the flip side, their order book seemed pretty solid. Orders received came in strong at $446.3 billion for the quarter.
That's true. Strong orders, strong revenue. But that significant profit miss. So it's no real surprise the market reaction was a bit subdued, maybe. Shares saw a modest dip after the announcement.
It really highlights that divergence, doesn't it?
Yep.
Growth is great, but if it doesn't flow through to the bottom line, investors get cautious. They start asking, is this sustainable growth? Or are costs eating into it?
Precisely. Which leads us to the next question. What caused this gap? Why the disconnect between that impressive revenue and the lower net profit? Where did the pressure come from?
Well, let's get into those drivers.
Okay. The main reason, the primary culprit for that dip in profit before tax and net profit was a big contraction in foreign exchange gains.
FX. Always a factor for global companies.
Exactly. Basically, the yen appreciated. It got stronger against the US dollar compared to the same period last year. And that resulted in a $3.2 billion deterioration in FX effects.
So their foreign earnings were just worth less when brought back into yen, like a hidden tax almost.
That's a good way to put it. It directly hit their profitability. Currency swings can really bite, especially for an exporter like KHI.
Was anything else dragging things down?
Well, yes. The company also mentioned a surprisingly high tax burden ratio for the quarter, 56%.
56%? That seems really high.
It does. They said it was due to a simplified tax calculation method they use for interim reporting. Now, management did indicate this should normalize over the full fiscal year.
Okay, so likely temporary, not structural.
That's the expectation. But it certainly didn't help the Q1 numbers. It was another headwind for that bottom line.
Now, something else really interesting happened this quarter. Impacting the balance sheet and financials, a big strategic move. They sold a stake in Kawasaki Motors Limited, right?
That's right. A major move. They sold a 20% stake in Kawasaki Motors to ITOCHU Corporation. That deal closed April 1st, bringing in $80 billion.
And this wasn't just about raising cash, was it? It felt more strategic.
Oh, very much so. A significant chunk of those proceeds, $80 billion, was used specifically to repay interest-bearing debt.
Okay, so de-risking the balance sheet.
Exactly. A clear move to strengthen their financial position. And it worked. They kept the net debt-to-equity ratio stable at around 78.7%, similar to the end of the last fiscal year. So using an asset sale for long-term financial health. Smart move.
But I'm guessing that sale also had an impact on that net profit figure we were just talking about, the one attributable to KHI's parent company owners.
You got it. It absolutely did. Because ITOCHU now owns 20% of Kawasaki Motors, a portion of Kawasaki Motors' profit now belongs to ITOCHU, the non-controlling interest.
Ah, so less profit flows directly back to KHI's main shareholders.
Precisely. It led to a year-on-year increase in the profit attributable to non-controlling interests, which, by definition, reduces the profit attributable back to KHI's parent owners for the quarter. It's an accounting outcome of that strategic sale.
So helped the balance sheet, strengthened the company long-term, but created a short-term headwind for that specific net profit line. It shows how interconnected these financial decisions are.
It really does.
How did things look on the cash flow side after all this?
Cash flow was definitely an area to watch this quarter. Despite making some progress collecting receivables, KHI actually reported a loss of $7.7 billion in cash flows from operating activity.
Whole loss from operations.
Yes, and when you add in losses from investing activities, their free cash flow ended up being a pretty significant loss of $45.8 billion.
Wow.
Yeah, and that's a $43.3 billion deterioration compared to the same quarter last year. So definitely a metric they'll want to improve, and one investors will be keeping a close eye on.
Okay, let's shift from the overall numbers and zoom in a bit. KHI is a massive conglomerate. How did the individual business segments perform? Was it weakness across the board, or were there pockets of strength?
Good question. It was definitely a mixed bag, which isn't unusual for a company this diverse. On the positive side, rolling stock, their train business, showed much better profitability.
Okay.
They bounced back from some one-off expenses last year and got a boost from profitable domestic projects. Their business profit was up a solid $5.1 billion compared to last year.
That's a good recovery.
Yeah.
What about energy solution and marine engineering? How did they hold up?
That segment did well too. Orders were down, but that was mainly because last year's comparison was just exceptionally strong. Despite lower orders, both their revenue and business profit actually increased, thanks to a pretty robust business environment for marine and energy solutions right now.
Good to hear. And the precision machinery and robot segment, that's been a key growth area for them.
Still looking strong. Yeah, precision machinery and robot saw year-on-year increases in everything: orders, revenue, and business profit.
What's driving that?
A lot of it is continued strong demand for hydraulic machinery, especially from the construction machinery market over in China. That remains a really significant driver for them.
Okay, so rolling stock, energy marine, and precision machinery robots showing strength. Now, where were the challenges? Which segments face those headwinds we talked about?
Well, first up, Aerospace Systems. Their business profit decreased.
Why was that?
It seems to be a combination of things. Lower profitability because of a temporary dip in revenue from their Boeing-related business that can be kind of lumpy sometimes. Plus, they had higher fixed costs tied to shipping newly manufactured commercial aircraft engines.
Right, the complexities of aerospace manufacturing.
Exactly. It highlights the volatility in that sector.
And what about the big consumer-facing segment, power sports and engine, or PS&E? We know consumer markets globally are facing some shifts. How did they fare?
Yeah, PS&E is a really important one to watch. And it was tough for them. Interestingly, their revenue actually went up mostly thanks to higher shipments of four-wheelers to North America. The business profit decreased significantly. It got hit from multiple angles. You had the stronger yen hurting them, higher fixed costs from investments they've made in production, and then, critically, the impact of U.S. tariff policy.
The tariffs.
Yeah, tariffs are definitely biting. And on top of that, they're seeing weakening demand overall in the U.S. power sports market. It got serious enough that they actually revised their full-year wholesale volume forecasts downward for motorcycles and four-wheelers PWCs in developed countries.
That's a clear signal of ongoing pressure in that key market.
Absolutely. It's a really challenging environment for the PS&E segment right now.
So given this mixed Q1 strong top line but profit pressures, especially in PS&E, how did management frame the outlook for the rest of the fiscal year? Did they lower their guidance?
You know, surprisingly, maybe even confidently, they largely maintained their full-year profit guidance for fiscal 2025.
Really? Even with the Q1 miss and the PS&E headwinds?
Yep. Business profit forecast remains at $145 billion, and profit before tax stays at $115 billion.
What does that signal to you?
It suggests management believes these Q1 issues, like the FX and maybe some of the cost pressures, are either temporary or crucially manageable within their existing plans for the year. It's a pretty strong statement of confidence, actually.
But presumably, they had to tweak some of the underlying assumptions to hold those targets, right?
Mm-hmm.
Especially given the currency moves and those tariffs.
Oh, absolutely. They made some key revisions. They changed their main FX assumption. They now expect the US dollar to average 145 for the year, up from 140 previously, and the euro at 165, up from 155.
So assuming a weaker yen for the rest of the year.
Exactly. And they were quite explicit about it. They stated that this weaker yen assumption helps offset the direct financial hit from those recent US tariffs.
Okay, that makes sense. So they're basically building the tariff costs and the weaker yen benefit directly into the forecast now.
Right. It gives investors a clearer picture. They're not just hoping the tariffs go away. They're saying, okay, here are the costs, here's the FX offset, and here's how we still hit our profit target.
Gotcha. What about the outlook for orders and overall revenue for the full year? Any changes there?
Interestingly, yes. They actually raised their full-year orders guidance by $30 billion up to $2,230 billion. So demand still looks really robust.
Okay, that's positive.
But they slightly trimmed the full-year revenue guidance by $20 billion down to $2,290 billion.
So strong orders, slightly lower revenue forecast. What might that suggest?
It could mean they see that strong demand continuing, but maybe converting that demand into actual recognized revenue might happen a touch slower than initially thought. Could be supply chain timing, production ramp-ups, things like that.
And how did these overall adjustments filter down to the individual segment forecasts for the full year?
We saw some shifts that reflect the Q1 trends. Aerospace Systems actually got an upward revision to its business profit forecast, up $8.0 billion. That's mainly thanks to those better FX assumptions and good cost control.
Right.
Rolling stock also saw its profit forecast nudged up by $1.0 billion, reflecting that improved profitability we saw in Q1.
Makes sense. And I assume power sports and engine went the other way.
You guessed it. In contrast, PS&E saw downward revisions to both its revenue and business profit forecasts for the full year. That's primarily pinned on the ongoing tariff impact and that weaker U.S. demand picture. It really highlights where the main pressure point is expected to be for the rest of the year.
And crucially for income investors, the dividend. Did that change with the Q1 profit dip?
Oh, good news there. They maintained the annual dividend forecast at $150 per share.
Okay, so stepping back and looking at the bigger picture, the investor context, what's the strategic story KHI is telling beyond these quarterly numbers? And what are the potential future catalysts we should be watching?
Yeah, this is where it gets really interesting, beyond just the immediate earnings beats or misses. Those recent moves, especially selling the stake in Kawasaki Motors, they really highlight this ongoing strategy KHI has. It's about pruning the portfolio in some areas while making targeted investments in new growth areas.
Right, using the cash from the sale not just to pay debt, but to reshape the company.
Exactly. De-risking the balance sheet, yes, but also creating flexibility. It's about maintaining financial stability while keeping a significant stake in a core business like Motors, but freeing up resources to bet on the future. It feels like a very deliberate repositioning effort over multiple years.
And what are these next generation businesses they keep talking about? What are the big bets, the potential game changers?
There are a few really significant ones. First, the hydrogen supply chain. KHI is genuinely a pioneer here. They're not just talking about it, they're building it. They started construction on the world's first commercial-scale liquefied hydrogen base back in May 2025, working with partners TA Corporation and TOA Corporation.
The first commercial-scale base, that's huge.
It is, and they're also working with shipbuilders like Imami and Japan Marine United on designing the next generation of liquefied hydrogen carrier ships. This is a massive long-term play on global decarbonization, and KHI wants to be a foundational piece of that infrastructure.
A potentially enormous market if hydrogen takes off as predicted. What else is in that next-gen bucket?
Second big one, medical robotics. Their Hinotori surgical robot system, which they developed with Sysmex and their joint venture Medicoroid, is gaining traction. Over 11,000 procedures done, 90 systems installed. Steady growth.
Okay, making progress.
But here's the key catalyst. Medicoroid is expected to actually become profitable this current fiscal year. And from next fiscal year onwards, it's expected to start contributing significantly to KHI's overall business profit.
So moving from investment phase to profit contributor, that's a major milestone.
It is, and they're pushing the boundaries, too. Just this past June, they did this incredible remote surgery demonstration, a surgeon in France controlling the robot in Japan. 23,000 kilometers apart. Directed by Mr. Jacques Marchot, supported by NT Communications. Think about what that means for accessing specialist care globally.
23,000 kilometers. That's mind-blowing. It's not just tech. It's potentially changing healthcare delivery itself. That's a powerful story. Anything else surprising in their future bets?
Yeah, one that kind of leverages their older industrial skills in a new way. Aquaculture. They have this thing called the Minato project.
Aquaculture, fish farming. How does that fit?
Well, KHI has decades of expertise in things like water treatment and fluid control, from building plants, ships, even trains. They're applying that know-how to fish farming. The goal is to achieve much higher stocking densities, making fish farming more efficient, and also enabling it in coastal areas where it wasn't feasible before. It ties into food security, particularly for Japan. Pretty clever use of existing skills.
Fascinating. Applying industrial engineering to food production. Okay, so wrapping up the quarter. KHI delivered that record revenue, strong business profit growth, but net income took a hit from the stronger yen and those tariff costs.
Right, a real divergence.
Yeah.
But management held firm on their full-year profit guidance, baking in new FX assumptions and the tariff impacts.
And strategically, they're making moves, selling stakes, paying down debt, but more importantly, investing heavily in these potentially transformative future businesses like hydrogen, medical robotics, even aquaculture. It shows a company actively trying to evolve.
Definitely. It sets up an interesting tension for investors, especially considering the KHI ADR has been on a tear, up over 100% in the last year, way ahead of the broader Japanese market ETF.
All right, let's put on our hypothetical investment committee hats for our This Is Not Financial Advice segment. Let's brainstorm a potentially audacious, but maybe, just maybe, plausible trade idea for Kawasaki.
Okay, I'm listening. The market's reaction to this quarter felt pretty muted, right? Focused on the immediate stuff, tariffs, FX pressure.
Exactly. It feels a bit backward-looking, especially since management basically said, we've got this covered in the full-year guidance. The market seems fixated on Q1 headwinds.
So what's the audacious pitch?
Here it is. Consider initiating a long position in KHI. Maybe structure it with long-dated call options to get some leverage and define risk. But the key is, we're not betting on the next quarter's earnings print.
Okay, so what are we betting on?
We're betting on a significant re-rating of the stock based on the market finally waking up to the real, tangible value being created in their hydrogen and medical robotics businesses.
So it's a longer-term narrative play. The thesis being that once Metacroid hits sustained profitability, which could be quite soon, and that first big hydrogen base is up and running maybe closer to next fiscal year, the story around KHI fundamentally changes.
Precisely. It shifts from cyclical heavy industry company with mixed quarterly results to something more like pioneering green energy infrastructure and cutting-edge healthcare technology play. We're betting on a narrative inflection point that just isn't priced in today.
So you're essentially trying to front-run the potential ESG and medtech valuation boost for what's traditionally seen as an old-school industrial name.
Just exactly. Leveraging a potential reallocation as big funds. Look for diversified ways to play those high-growth, socially impactful themes through an established, maybe currently underappreciated company like KHI.
It's definitely audacious, focusing on the future potential rather than the immediate numbers, a compelling long-term perspective for sure.
As always, remember this discussion is purely for informational purposes. It is absolutely not financial advice. We strongly encourage you to do your own research, your own due diligence, and consult with a qualified financial professional before making any investment decisions.
Indeed. And we'd love to hear your thoughts on KHI in this quarter, so please do share your insights on today's deep dive.